Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Thursday, the 3rd of November. I'm Daniel Lam, your host for the podcast. As expected, the Fed delivered a 75 bips rate hike, bringing the cumulative increase in the Fed funds rate to 375 bips since the start of the tightening cycle in March. Now, the key difference compared to the September statement is the inclusion of a new sentence stating that in determining the pace of future increases in target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Initially, investors saw cumulative as pointing to slower hikes and possibly to a lower peak to hikes. However, Chairman Powell comments at the press conference stating that an expectation that the peak of policy rates will be higher than the 4.625% median seen at the September FOMC meeting. So initially, the market reading was dovish and asset market was supportive. But then it flipped to negative as it became clear that Powell's meaning was less market-friendly than first thought. S&P 500 was down 2.5% for the entire day, with Nasdaq taking the blunt and down by more than 3% due to the hawkish tone of the statement. The key takeaway from this meeting is that although Powell underscored that there is elevated uncertainty around the level at which interest rate becomes restrictive, he did note that resilient labor market conditions and stubbornly elevated inflation suggest that the Fed remains focused on tightening monetary policy. This statement is likely to lead to pullback in risky assets in the short term. Support level in S&P 500 is initially at 3,700, followed by stronger support around 3,500. US 10-year government bond yield is likely to be supported at 4%, while the DXY is likely to be supported at 110, with likely resistances at 113. We continue to stay defensive in high-quality income assets, such as DMIG corporate bonds and global high-dividend equities. Adding exposure today well into a Fed hiking cycle lowers reinvestment risk, i.e. the risk that bond yields are much lower in a year's time or longer, potentially forcing investors to accept lower income at that point. The next macro data to watch would be the non-farm payroll tomorrow night Asian time and US CPI on the 10th of November. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.